we're going live. Guys, thank you. Thank you so much for joining us today. We're going to record this. We'll share some stuff afterwards, but really appreciate the time that you're sharing. And not only that, but just your expertise. You all come from a specific background in venture, crossing different, parts of that industry. And so I think we're going to have a great talk today. As a reminder, like, what is this about? Like, the goal of this conversation is, building a fund is a lot more than just raising capital. And so when we think about setting up the right operational foundation to scale that and attracting the right LPs, there's a lot that goes into that. And so excited to have you join. We'll have some poll questions today. I've got some other questions prepared too, where we'll dive into it. But overall, thank you for joining. And if maybe we kick it off with just like a quick intro overview about yourself, that'd be probably the best way to start. Vincent, you want to kick us off with this?
Sure, happy to. So Vince Timoney, I'm a senior managing director here at Citizens Private Bank, kind of serving the venture capital private equity ecosystem. Been a lender at 3 different banks serving that community, and also spent time at a law firm briefly, and then also did a stint at a fintech where I led go-to-market strategy, strategic partnerships, led our SaaS sales team there, and helped build out a number of products that serve the venture ecosystem.
Well, glad to have you here, Vince. Ed, why don't you tell us about yourself?
Sure. Ed Zimmerman, and I am a partner at Lowenstein Sandler, which is a law firm in New York and elsewhere, where I co-founded in the 90s our emerging companies and venture capital groups. We represent venture funds and startups and growth companies. And I've been teaching venture capital in the MBA program at Columbia for about 18 years and taught startup law and internet law before that. In 2020, my wife and I, with some friends, co-founded a fund of funds that invests in venture capital funds that have underrepresented ownership. And we do that on a global basis. That is called First Close Partners. And that was really the continuation and institutionalization of LP investing that my wife, Betsy Zimmerman, and I have been doing for many years, because before doing that, we had invested in over 100 venture funds, predominantly but not exclusively US. First Close itself has raised 2 funds, and we're deploying our 2nd fund.
Awesome, exciting, and thank you again for joining us. Bonita, tell us about yourself. Thanks for being here.
Yes, pleasure to be here, and good afternoon, everyone. I'm Bonita Stewart. I'm the co-founder and managing partner at Bag Ventures. We're a pre-seed seed fund investing in visionary founders who are reshaping the enterprise with AI-powered software solutions. I spent most of my career in technology or working in a large enterprise, and I most recently served as a board partner with Gradient Ventures, which is Google's early stage AI fund. I've also led sales and operations, global partnerships, also serve on 2 boards, Decker's, as well as PagerDuty. So if I were to give a headline for myself, it would be an operator investor.
Awesome. Well, anybody that's here on the call today, we've got a pretty good, I'll say, coverage on what venture is outside of just raising the capital. We're going to do a couple of poll questions just right off the bat. Love to know specifically who's joining us today and what's of most interest. We're going to try and tailor some of the advice and answers and coverage to who our participants are. And then I'll give us a little bit of time to answer that, but then I've also got some questions and we'll dive into those and we'll kick things off. So I'll give us like a quick, let's say 30-second break here, and then we'll dive back in. I think too, at this first poll question, it's definitely going to shift. What are the things that we cover on this call pertaining to if somebody's still planning, has not launched a fund yet, as opposed to they're down the road a little bit. I think we've all got stories of I think Bonita, when we met last and you said, how you start is how you finish, and I was like, oh yeah, we've all bumped into those items where it's like, oh, if we could have made this small minor change up front, we might be having a different conversation today. All right, we're gonna give this like another 5 seconds, and then we'll dive back in. Okay, so poll answers are in, and we're early, which is great. I love seeing that. So haven't launched yet, still planning, 37%, and then we've got launching first fund this year. And then obviously there's others too, but that's gonna be the focus, I would say. I'm gonna kick us off with this first question. So, we've got a little bit of background of who everybody is on the call. I didn't introduce myself real quick. I'm Jeremy. I help lead sales at Sydecar. We create product for streamlining venture capital investments in SPVs or syndicates, but also in funds. And so, anyways, happy to be here. Thank you all for joining. For this first question, I mean, when we look at what stage people are currently at, and we just saw that it's like still in the planning or we're launching, the first one. I think we're going to see a lot of advice today on like future thought. How do we set things up for success, and ultimately not get too far off what I would say maybe is like the tried and the true of what are best practices. So, this first question goes out to all of you. When we ask the question, like, what does it actually mean to operationalize a fund? And then kind of secondary to that is, why does that matter so much to LPs? I'd be curious to hear what your thoughts are on that.
So maybe I'll jump in because I do think it's important as a fund manager, and it was great to see that there's 37% that are actually in the planning mode, because I do think what excites you most as a fund manager, quite frankly, if we're all honest, is finding those founders, the innovation, and investing and creating a return. I do think in the beginning, it's important to flip that a bit and say, you actually have a fiduciary responsibility to LPs. And what does that mean? And that means you have to execute well, you have to still obviously offer return potential. And so one of the things that Jackson, George, and I, as we thought about our fund, we said it is how you start, is kind of how you determine your long-term operational rigor and scalability. So I think it's important to think about the back office and these key intersection of just operational elements. So when you're thinking about fundraising, yes, that's one lane of operations, but it actually is, how are you going to do the capital call management? That's operations. When you think about investing, yes, you're looking for that, that needle in a haystack, that's going to give you that, 5, 10x return. But that also is accounting. It's taxes. We just had that this week. We have K1s, coming out. It's audit. And all of this requires cross-functional communication. So I would say that it's important to build that rigor early, so you have that mindset of being a fiduciary, and creating a defined and repeatable process in operations so you can do what you really love, is finding interesting investment ideas.
Yeah, I think, Bonita, I agree with everything that you said there. I think most of the people that are probably saying, hey, I'm thinking about starting a fund or getting that going, have already been doing, either angel investing or maybe they're at an existing firm and thinking about striking out on their own. And that is a shift, because you have to go from, to Bonita's point, going from just identifying investments that you really enjoy to thinking about, essentially how you're going to run a company, right? I think oftentimes, emerging managers don't realize how much work and time is required to get a firm off the ground. From finding a banker, finding a lawyer. Yes, those are service components, but the investment strategy and sort of what that investment model is going to look like. What's the minimum viable fund size that you're going to need to get to execute on your strategy. Those are all things that you're going to need to find time to put together and make sure that when you're getting in front of those LPs, that you have that down. So trying out that pitch a number of times. Just like any founder would, so that when you're asked those difficult questions, specifically, why should your firm exist, right? This is a fundraising environment right now that's very, very challenging, even for established managers. So to be a new manager in this fundraising environment, you really need to have not only the operations dialed in, but the core answer of why this new firm needs to exist dialed in.
And I think that when you think about the transition from doing SPVs to doing a fund and how long you will have to give these folks K1s and audited numbers and the cadence of your communications and operationalizing around that. How am I going to send out the next 14 years of financials and K1s to people? How am I going to make sure that I'm staying in touch with these people in a way that is, good for them, and that I'm going to figure out like how to actually call the capital and make sure that people who are late have a response and that we can follow up because someone's going to miss it or be late. So understanding those kinds of things, particularly because, as Bonita said, a number of folks on the call are at the planning stages. 14 years, 15 years is a dauntingly long time period, but you got to plan for it.
It's all of that's well said. Very much. Hey, this is the most fun aspect. I don't think any of us will sit here and say the admin is the most fun part of running a fund, but is crucial to having fun at the end of the day, and you're going to be in it for a long time, which kind of all the things you all said or pointed to. We've got a second poll question coming up, and it's specifically going to ask, hey, when it comes down to it, what operational areas do you feel least confident about today? And it might even just, if other is the one that's selected, it might just simply be the fact of, I don't know what I don't know, especially if you're still in the planning phase. So I think we'll have some really good conversation on this too, because if you don't know what you don't know, where do you go to even find that in the first place? I'm sure we've all had those conversations too, where you bring up the concept of, hey, have you thought about this? And it turns into an excellent conversational piece because, until they met you, it was just out of frame, out of mind.
Yeah, not only that, I like, Ed, your focus on the long-term nature of the decision. I think something I see a lot with emerging managers is they haven't really thought through the fact of how long-term a decision it is to raise a fund, not only for what you want to do with your own time, but also the relationship you're going to have with if you have a co-GP, right? Is that someone? It's kind of like a marriage in a way. Is this someone that you're ready to start a marriage with for the next 15? Hopefully, if you're doing fund 2, fund 3, 20 years. Also, the LPs, these are people you're building a long-term relationship with. So just the idea of why operations is important is hopefully you're not only being a fiduciary like Bonita said, but also you're going to be working with these people hopefully for 15 plus years. And the same is true for the portfolio founders that you're identifying. So it really is a long-term commitment that you need to really be sure is the right decision for you.
Mm-hmm. All right, poll questions out, and the answer, I was kind of expecting this. Legal and compliance setup, especially for first fund. And then we've got, Bonita, what you mentioned too, capital calls, onboarding, fund admin, the meat and potatoes, what we're going to end up going through. this kind of pivots well into like the second question that I've got teed up for us. And I didn't plan for this, but Bonita, we'll start with you again. So Google's an anchor LP in Bag Ventures, and that's an institutional LP where most emerging managers would be very happy with someone of that caliber joining. I think we'd be curious to hear, like, how did you approach building the operational side of this of Bag Ventures, where it helps secure the backing of not only Google but other investors as well. And in part, maybe to add to that question, like, does part of that operational foundation that you put together or had help putting together, does that increase credibility? Does it speak to other aspects? I'll kind of stop talking now, but we'll just start with that.
I'll take it in 3 chapters. So the first chapter was the fact that going to Google and even mentioning to them that we were going to launch a fund. We had spent time, my partner, we had co-founded the Black Angel Group. We have over 300 members across 90 tech companies. They thought it was a really cool idea. It started at Google in terms of just organizing this community of tech operators. And then we had a professional track record. So we knew how to drive revenue at scale. You know, we've had leadership opportunities. We've had accountability and obviously a vast tech network as well. And then we also had experience. So people sometimes don't know that Google Alphabet has 3 funds. So there's GV, which was formerly Google Ventures, and then Capital G, which is late stage growth, where Jackson was at Capital G, and then I was at Gradient Ventures. So we had a track record in terms of accountability, and we also had experience at the funds. So the first step, they said, well, look, you're here. Why don't you become entrepreneurs in residence? And we said that would be a great idea. And so we had the privilege of doing that. If there's anyone on the call where you have the luxury of time to actually plan, that we did it for a year. So that was the first step in terms of building our operational foundation, really so folks could watch us in action. We were whiteboarding, we were, thinking about our fund, our portfolio construction. And then as, quite frankly, as Jackson and I, had spent, time, as within Google, so we both came with that Google DNA. We were thinking about OKRs. We were thinking about our KPIs. We had a strategic plan. We also know how to pivot. What were the changes that we would need to make? And it really started with the portfolio construction, because that became a key driver of our operational strategy, because that determines your GP commit. It determines, yes, you have, and there's flexibility even on the 2%, of the management fees. And so that was important for us. And then also knowing really how to hire. So we were thinking about what's the talent on our team? So we were spending time talking to other emerging managers, successful emerging managers, about their providers, so that we could pull together our team. Because, as Ed mentioned, it's not just a partnership for your LPs. It is actually, we wanted to think about this as a partnership with our providers. We didn't want to have start and stop. We actually wanted long-term relationships with our providers. So we spent time actually vetting, researching, and choosing our providers because we thought that would be important. So 1, we came with a track record. 2, we spent time as entrepreneurs and residents really working the plan and looking at our providers. And then thirdly, in terms of really getting that check, as we graduated, from our entrepreneur and residence, We now have all three funds are advisors for us. And we also have two senior executives who are advisors for us. We also, as Google came in to invest in the fund as our anchor, we also had Jeff Dean's family office. He's the chief research scientist. So we had a foundation of a family office, and we had Google. But I think what we brought was a track record and a belief, and also that we know tech. And we were looking at how we were going to transform the enterprise. Really thinking about technology. The first person we hired on our team was a software engineer, because we know with AI, we have to be able to really unpack the tech and do that technical review on behalf of our LPs. So that planning was important, and being able to demonstrate how we could make a difference within the emerging manager category. That brought the confidence of Google to actually write that anchor check. And then we also had individuals who came along, quite frankly, because we had this Black Angel operator group, but we now have 110 individual investors. So we have a whole collective now of LPs that provide experience. So I think what I would say is it's balancing you can balance the nimbleness, but actually invest in yourself and that planning process. You don't have to jump out here too quick. The fundraising, it is what it is, based upon the macro economic headwinds. But if you have stability that allows you to execute well. We've done 4 investments. We can go slow. It's okay. But that's because we feel that we have a solid operational foundation to be able to execute with excellence.
That's well said. Vince, Ed, anything to add to that?
Yeah, I think I just saw, in the poll that, folks were, maybe less confident about finding somebody like Ed, right, to put together an LPA and help them get those organizational documents in place. And so, the number one thing is to utilize your network. Again, hopefully these are folks that have already been angel investing. They know founders, they know other GPs. Ask them about the vendors that they utilize. And make sure that you fit not only the name of the firm that you're working with, but also the individual at that firm that you're going to be working with is a good fit for you, because again, hopefully that's a long-term relationship, and you're going to want to be able to trust them. Bring them difficult questions and make sure you're getting that proper advice. So not only for legal, but for fund admin, for banking, for tax, for audit. Those are all core service providers that are hopefully long-term relationships for you, and make sure that you do your diligence to find the right fit for you.
And I do think, with fund administrators, it can be really hard if you're subscale. It can be really hard if you're just starting out, because getting the right attention at those places, like at First Close, we have a large portfolio. Not all of the funds that we've invested in are emerging. Not all of them are small. We have some funds where the fund itself is over 500 million, and the fund complex is over $1 billion. But enough of them that are small have problems with the service providers that they're using or the platforms that they're using, because they're not getting the right attention, and they're not getting people who have been there, done that before. Part of it is also mindset. If your mindset coming into that relationship is vendor coin operated relationship, then you're likely going to get back that kind of mindset. If the mindset is, how do we build for the long term? How do we engender trust? How do we ensure that they know enough about what we're looking for to actually give us wisdom and judgment and see around corners? Then either that pays off, or you're with the wrong people.
Yeah, I do see timing as a really big factor here. When you try to rush through this, that's when we start to uncover things. Maybe it's choosing the wrong vendor or missing something in a I'll just say LP diligence that comes back and bites you later. I get it. Things move quickly, but as we've kind of all touched on, it's much bigger than just deploying capital. And so to take your time and ask for help, to talk to as many vendors as you can, to lean into your network. I think that might be one of the best parts about the venture community is that lean on your friends, lean on those who may know more, and get the support that ultimately you should be putting the diligence into.
So two quick things. One, we've got a handful of questions in the Q&A. Several of them deal with K1s for SPVs. And the answer is yes. If you've launched an SPV and you've used a partnership or an LLC, you need to send people K1s. If you've done 5 LLCs, congratulations, you've won yourself the obligation of sending K1s for each of those, which is part of why the more permanent fund structure makes a lot of sense once you're getting to scale, and part of why, don't get into it unless you're willing to be sending K1s for a decade. And then just the one friendly amendment to the comment about leaning into your network and relying on your network. One of the ways that historically venture ends up causing people to skew away from a more diverse and inclusive network is by staying inside that network for additional relationships and resources. And it is particularly valuable to transcend that network and to have a more diverse and spreading network, and be open to ensuring that you are looking beyond just your comfortable network.
Well, and kind of along those lines of pointing out like red flags when it comes to the legal or the operational standpoint of like an LP doing diligence, what kind of advice would you give like an emerging manager to proactively avoid them? One of them being, hey, transcend your network, but what else kind of comes to mind?
Yeah, so first of all, this answer is going to differ based on who the LP is, and you should be doing some sleuthing about who the LP is and what their what their hangups are. So for instance, you can find out pretty easily that Sandana has historically announced to the world that they're willing to look at solo GP funds. Others haven't. I'm not saying you shouldn't talk to an LP that has publicly said we don't really like solo GP funds, or UTIMCO has said no emerging managers. So if you're a first-time or second-time venture fund, you probably don't want to spend a lot of energy trying to get UTIMCO. That doesn't mean that you should cut them out. Just you should know going in what folks have said, to the extent that they've said these things publicly. In terms of some of the other prep stuff, I think it does make sense to ensure that you understand what should be in your data room. You understand that having a model in your data room is going to be important, that reflecting reserves appropriately will be important, and that if you do something with your reserves, so we invest in funds that have reserved 50% for follow-on. We invest in funds that have reserved very, very little, next to nothing for follow-ons. We do want to hear, when we ask the question, why 50% or why next to nothing, we do want to hear a thoughtful answer. We get to decide what we think of that answer and that approach for that specific manager and that specific market segment. But if the answer is because someone told me it was market, or I'm not really sure, that tells us something. So you have an obligation to educate yourself about that. And similarly, understanding how to manage expectations. So if someone is asking you about how quickly dollars should be flowing back to them in a pre-seed fund, you might either be talking to the wrong folks, or you might need to level set and make sure that if this is otherwise a legitimate lead, that you're managing their expectation. And the answer is like, it's going to be a really long time. So you should go in, understanding that. And I think finally, I would say changes in your team turnover is a really big issue. It's particularly a big issue given the dynamics that we've seen in the marketplace in the last several years. If you don't have an answer ready for that question, and if you aren't aware of the pros and cons that you're going to hear in the marketplace, because if you're doing venture, you're in the business of turning down more investments than you green light. And people, like, surprise newsflash, people don't love to be turned down. And like 15 years ago, it was fine to turn someone down, and you could get back to them and you could write them a really thoughtful response about why you're turning them down. Deal flow was much smaller, and we had a much smaller community 15 years ago. Today, you cannot possibly, I defy people to be able to actually do that if they have an actual venture fund and like significant deal flow. It's really hard. So you're gonna disappoint people, you're gonna piss people off. Have an understanding of what LPs who do off-book reference checks are going to hear, prepare yourself for it, and when they grill you about those things, accept that with grace. LPs are doing their jobs, and in a down market, whether it's not their job because they're high net worth individuals or whatever, they've got to protect themselves, and you are opening yourself up for that scrutiny. And if they pass on you, then understand that a pass for fund 1 or 2 may be a yes for fund 3 if you take that pass with grace, and if you figure out how to appropriately follow up. A pass in fund 1 that is taken without grace can be something that gets discussed among LPs repeatedly and can haunt you.
There's a lot of good stuff in that. Thank you, Ed, for touching on that. I'm sure you've seen a ton at this point, so that insight is great. There's a question here specifically about reserves, and I'd be curious your thoughts. It says, how much can you legally take in reserves for follow-on? You're mentioning 50%. You said a different number as well. I think that's it could be a really broad answer, but pertains to maybe if we're talking about an early stage fund, just comments, thoughts on that.
I'm happy to go second, but I can go first.
Yeah, I mean, I can
ahead.
jump in as well. I think reserve is really about your fund strategy, right? I think that's the number one key. Ed kind of touched on it. Whether it's I'm not going to have anything for reserves, and hopefully I'm going to be recycling capital, versus I'm going to reserve 50% because I want a much more concentrated portfolio. You just need to be able to explain that strategy. I would say for probably most of the people on this call, they're focusing on very early stage, pre-seed and seed. Having a large reserve, not sure that that's very common at that stage. So you would really want to think through, why you want a more concentrated portfolio versus, the more traditional, hey, at the pre-seed seed level, I need as many shots on goal as possible to identify some outliers, and potentially if there is an outlier and I have some pro rata, the ability to raise an opportunity fund, raise an SPV that you offer up to your LPs for some type of co-invest. Those are probably the things that you should be thinking about, as opposed to what's the exact percentage I want at the fund for reserves.
Vincent, I'll just add on to this what you and Ed have said, but I would just like to stress the importance of doing portfolio construction. You need to do the math. To actually understand how you're building your fund based upon your strategy, what stage you're focused on. And then after you build your portfolio construction, then you do the portfolio construction rationale. Why are you doing it? And then we actually spent time talking to a number of people, really getting feedback. And we've adjusted our portfolio construction, because it's like, aha, that makes sense, we need to adjust it. So really do the math, have the portfolio construction, and more importantly, then why are you doing it? So that you can be able to articulate why you're doing what you're doing. But doing that again early on, and you can't pivot, along the way, but then why? Just always have a why and be very transparent. We were very transparent with our current LPs and even potential LPs. Oh, we made a change, and here's why we made the change. So I would encourage that.
Yeah,
The-
agree.
The other thing I would say on this topic is you can't really talk about, I mean, you can talk about reserves without also at least being ready to talk about recycling. And recycling is not just a response to, climate change and pollution. Recycling in venture means that you are taking money that you have received from your portfolio companies and you are redeploying it back into the fund. And understanding that research has demonstrated that the most successful funds are typically 100%, 95 to 105% or more deployed, and that you are going to, once you net out expenses, only have 80% or so of the corpus of your fund to actually invest, meaning you have to turn 80% of your fund into 300% of your fund. And it's easier to turn 105% into 300% than it is to turn 80%. How do you structure your fund on day one to enable you to deploy 105 or 110%? How do you structure it along the way? How do you resist the chocolate covered donut of taking the cash the first time it comes in and instead redeploying it and have your LPs not hate you because you're redeploying it and because you've planted the seed during fundraising that you are going to redeploy and recycle? How do you think about cannibalizing your own management fee so that, which is what you need to live on, so that you can maybe use some of that to commit more early? There are a whole bunch of different strategies. Educate yourself, maybe even expertise yourself about that, because you need to understand and be thoughtful about this, because it goes into the model and your portfolio construction. And if you do a first close at 20 million on a fund that's supposed to be 60 million, and you don't close another dollar, how does that change because you have a black swan event like Bear Stearns or Lehman Brothers or the onset of COVID or an insane president implements tariffs? Like, what are you doing to prepare to execute on your strategy for a first close? Because it will freak out your LPs and they're stuck with you for at least a dozen years if you don't have a good answer. And we all know, and I signed term sheets for venture deals on September 10th of 2001 in New York. We all know that stuff happens and your first close may be the only close, right? Or, you may only add 5% on top of that. So be prepared and have a game plan that you communicate to people. We're going to target this bigger number, but if we get there, because you're not going to recycle and you're not going to have a lot of reserves if you close on 30% of the fund and only add, get up to 32% of your target.
Yeah, I think that's right. And kind of dovetailing off of what Ed just said and Bonita referenced doing the math as well. I think a lot of times, a conversation that I end up having is around, sort of how folks are going to make money if they haven't had a life-changing, wealth event prior to launching a fund, right? You're typically, if you're coming from an operating background, you're no longer going to be a W-2 employee, right? You're reliant on your fees. So really what you're going out and raising in that fund one is going to be you and the salary and all of the expenses of the firm are going to come from that. So you really need to do the math on, what makes sense for you from a living situation based on, your financial background. You're going to have a GP commit, that you need to make into the fund as well. Is that something that you're comfortable doing out of pocket, or do you have another strategy for how you're going to come up with that So making sure that you're not only doing the math on the fund and how that's going to work from a modeling perspective, but also doing that same modeling for the management company and for you personally, and how you're going to live for the next 10 plus years.
A lot of good stuff in there. It's funny how it actually really ties into this next poll question that we're going to throw up, but it ultimately comes down to fund expenses. So how are you planning to manage those? Have you run the math? What happens if you don't make it past the first close? From my perspective, seeing a client or prospective client switch fund managers mid-fund is a tough conversation because you've sunk so much time and costs, and it's not easy to switch. Same thing with any other provider that happens to be a part of it, who's maybe doing your taxes year 4 if it hasn't been a good experience up to date. There's so many of those things that come into play. Man, I love the expertise you all have. This is excellent. We'll give this like another 10 seconds and then we will dive into it.
Sure.
Got a hunch just knowing where people are at with what fund they're taking a look at. But Vince, I'm going to tee up a question for you too right afterwards.
Sure.
Okay. Wow, this is the majority. So biggest challenge today.
Not surprising.
Yeah. Upfront costs before LP commitments come in. You're right. Not surprising at all. So this is teed up for you, and obviously everyone can participate in this, but you're on the
Yeah, I
go.
know. Everyone on this panel, I'm sure, has dealt with this many times over and had this conversation a lot. But I do think it's probably the most overlooked aspect of raising a fund is, oftentimes you are now reliant on the fund for your income. And if you haven't had a wealth event prior to launching your fund, maybe you were an operator or you were a founder and now you're doing this, but that company hasn't exited. Yeah, you're switching to an environment where you don't have a steady, W-2 income. So what does that look like? And I think a lot of times, the perspective of emerging managers is that there is sort of a debt solution or a solution where maybe an LP will float you for a while or something like that. Those are not all givens. There are certain situations where that might be possible based on your personal balance sheet and assets that are lendable there for somebody like myself. There might be situations where you have a strategic LP that's willing to help with those formation costs and float you until you get to a sizable first close and can start drawing fees from that. But really, you need to make sure that you have your own strategy for what you're comfortable from a living perspective, having that life look like. If you're going from a W-2 salary of 500K and that goes away overnight to go launch this fund, do you have enough saved away to go spend a year putting this fund together and getting to that first close, or just things that you need to model out, and especially if you have a family, and making sure that you have that conversation about what life's going to look like. We talked about it earlier in the call, but this is very much a long-term decision about what you're going to do. It's not something that you can go run to fund for 2 years and decide it's not for you and walk away. That's not how it works. So make sure that you've kind of walked through that math, not only for how you're going to run your fund, but especially for you personally, and what it's going to look like. To Ed's point, if you say, hey, I'm going to go raise $200 million, and really that's where you've modeled everything out at, make sure you've also modeled it out at 100 or 75 so that you know that it's going to be okay if that's what you ultimately end up at it for Fund 1. I don't know, Bonita or Ed, if you have a different perspective on it.
No, that's why we were entrepreneurs in residence, quite frankly. So part of, doing this requires personal long-term planning to decide that this is something that you would want to do. And it does require capital, quite frankly.
Yeah.
To sustain yourself.
Is there an aspect of like reimbursements that any of you would touch on if that's part of somebody's plan?
Yeah, certainly. And Ed will know this from his many LPAs he's put together and reviewed. But typically, there's going to be language within there about fundraising costs, and sometimes there's a cap to that. Sometimes there's not. Oftentimes, you're going to want to make sure that you're closely tracking, and this will occur after you've had a close as well, about what's going to be an expense of the fund, and what's attributable there versus what's an expense of the management company. Making sure that you're definitely aware of what you can ultimately end up billing back to the fund to reimburse yourself during that fundraising process. You're definitely going to want to make sure that that's laid out very clearly in the LPA, so that you're not having any disputes with your LPs about that topic. And also, so what you're making sure as you're making a decision about, hey, should I take this flight, across the country to go meet an LP? What is that something that you can reimburse, or is that completely on you? Those are questions you should definitely have figured out and know very well ahead of time.
Once you have a second fund, you are going to also need to understand which things are expenses allocable to Fund 2 and its LPs, and
Yep.
which things are allocable to Fund 1, and how you split them. And people, so I spend a lot of my time working as a lawyer with venture-backed companies, and people often don't want a board, and they think that the investors are going to get in the way. The investors also, or the board members also, can give you cover for having made a decision about a self-interested transaction. The same is true with an LPAC, and building the muscle, building yourself out so that you are institutional ready, because in Fund 1, even though you didn't need an LPAC, you had one, and you got into the cadence of and muscle memory of working with an LPAC. Once you're starting to deal with cross-fund expenses, because your LP bases in Fund 1 and Fund 2, even if they're the same people, they won't be in the same amounts, and that's a place where you can get into trouble later. So making sure that you've put in place systems to understand how to manage that. And it goes back to Bonita's opening comments about you're a fiduciary, and you have to be prepared. You have to be prepared for that. In terms of, there's another question about how much you can take. We did, and I'm happy to drop this in the Q&A, but we did an analysis of 750 funds and what their opening offers were, or what their opening positions were on fee structure. And they were overwhelmingly in the 2 and 20 category. And for a number of funds, because there are other things that you're going to have to explain, like, I don't really have a track record, but I want you to use this other stuff as a proxy that indicates that I'm good at finding companies and investing in them, and I can win deals. Or, we're in this segment that not everyone understands, or we have a funky reserve system, or my co-founder has another day job. The more you have to explain, the more you don't want to have to explain what your management fee structure is, what your carry is. So to the extent that you can be boring on that stuff so that people can check the box and move on, it's better.
That's pretty great. You mentioned a couple of things in that answer. You mentioned an LPAC. You mentioned just going industry standards, being boring. What other institutional readiness, like what other items come to mind with that? Things that, as an emerging manager, hey, let's just set up now and make sure that we're all buttoned up as we go out to the market. Even if you're not going to accept institutional investors today, I'd be curious, what other things come to mind there?
Yeah, I think we do a lot of this for our clients, as well as reviewing their data room and sort of what they've got in there, and provide them with some best practices. As you start to look at targeting institutional investors, especially, but even family offices as well. A due diligence questionnaire is something that they might either provide to you, or you can just take a template from ILPA and have that already in the data room so that, as prospective LPs are coming, rather than having to complete a ton of different questionnaires, you've now got a pretty industry standard due diligence questionnaire that's sitting there waiting for them to check a lot of those boxes, and they can dig in if there's any additional questions. But having that in there, and making sure that there's sort of, here's all the different pieces that a typical data room should have, so that you look professional and you look like you know what you're talking about, and that you've done your research on what it means to be an institutional investor. That's going to go a long way as you start fundraising, even again. And I think Bonita referenced this as well. This might not be an LP that necessarily signs up for fund 1, but now you're on their radar, and so when you come to the market for fund 2 or fund 3, they remember, hey, they had everything lined up for fund 1. Happy to take a look at them again for fund 2.
Vincent, just to add here, because I do think it's important, and we work with citizens, so I just want to give a shout out, for citizens and also Bridge and Cooley, but they were so important for our data room, just the DDQ, and people, sometimes you underestimate, oh, it's that document, but these are the documents that are scrutinized during diligence. So yes, you get the call, you get the second call, you might get the no, but you are building this long term and your reputation. But when you do get into late diligence, it's so important that you've memorialized how you want to do cash control, how you're thinking about valuation, what are your operational policies? Like that comes in late diligence. So just getting ready is the DDQ and the data room, but then there's the DDQ and then the next DDQ questions that come that are in late diligence. And so anything that you can do that you could pull forward so that you're able to answer those questions. So even though they may not come as, they come later in the fundraising process as you get toward the end, but anything that you could pull ahead, I think is really important. And the partners that you have are really important in that process. I mean, we think about partnerships long term. We also think about the confidants, having Bridge Financial Alternatives, as our fractional CFO. I mean, that's the confidant, to be able to work with, citizens, work with the fund administration. We have a Duro, so you have to be able to move across those lines in a way that shows that you have institutional readiness as well.
And working out your arrangements with your own partners. Vesting of carry, having an understanding of what the deal is going in, what happens if someone leaves or if something happens to someone, being able to speak about that with LPs. So it's not, I'll get back to you in a week, because that's an answer at a fund with 2 GPs, 4 GPs. That's an answer you should have.
And do that up front. And I think I know this from board planning as well, is like, succession planning. Like, no, you have to do that up front. As soon as you start, you think about it. And then it's built into your legal documents and, your carry, as Ed's mentioning, but do that all up front. So when you do get the question, you're able to articulate, no, this is exactly how we're doing it, and it's all been agreed upon.
Yeah, this last question that we had was, what's one operational practice that you believe, sets top tier managers apart when it comes to building LP trust? And I mean, summarizing what the 3 of you just said in the last 5.5 minutes, it's like, if you're building your first fund, build it like it's fund 3. Like, really have these things buttoned up, because you get one impression and you're building this long track record, even if you don't win this LP today. I mean, I'm probably going to take the last 10 minutes of this call. Like, that's just, it's well said. We've got 4 minutes here. I'm going to open this thing up to the Q&A. If there's anything from the topics that we've covered or that we haven't, you guys can see this Q&A too. So if there's one in there that is, hey, top of mind, let's dive into it. But we've got questions on safes, K1s, borrowing money.
I
Whatever
can
you
just
think would
address
be
the,
interesting,
oh, go
Jeremy.
ahead, go ahead, Vincent.
Whatever you think is interesting, Jeremy, go for it. What's
Yeah.
the most interesting one in there?
All right. Ooh. I mean, a lot of these are touching on LPA, like how exactly did you structure this thing? That's what's going to give you the ability to do some of this stuff. But here's one where it's just talking about your ability to borrow money from working capital, payroll, etc., until a first close. How much can a new firm borrow? Is it a personal guarantee? I feel like Vince, you touched on some of this with like what's going to be appropriate for you, and it's an open-ended.
Yeah, we touched on that a little bit. Yeah, prior to a first fund, that's really going to be dependent on your personal situation by and large. Certainly we're not going to be able to lend to the management entity if there's no contractual fee obligations that are flowing into that entity yet, right?
Yeah.
So it's really about what personally are you willing to do. I think oftentimes for clients that I'm working with, it's often, do you own a home that you can put a HELOC on? Do you have public securities that we can do, secured back line of credit? What other, things are on your personal balance sheet that could act as collateral, up to and including a personal guarantee, of course, to get you to that point where you're going to, now have a close, now have fee income coming, have the management company ultimately, pay you back, pay off that line of credit. So definitely something that everyone should think about as they're getting on this journey is, what is my comfort level, with now not having an active income until the fund is started. That should definitely be something you're thinking about.
Yeah, well said. Be mindful of time. One, very appreciative of you being here, sharing your expertise, and for the folks that joined us today. From the Sydecar point of view, if you're early, if you're full of questions, if you're just interested in exploring what we can possibly do, we'd love to have that conversation. We're also just happy to point you in the right direction too, or further down the road if we're not a fit. Kind of going back to that network thing that we talked earlier about. But overall, thank you again for being here. And I mean, it's Thursday afternoon. I hope the rest of the week for you guys is smooth sailing.
Thank you very much.
All right, guys. Have a great one. Thanks so much.
You too.
Thank you,
Thanks.
everyone.